Welcome to Trader TV Equities, your insight into the trading climate for professional equity investors. I'm Dan Barnes. In February's show, we'll discuss the recent market volatility, how trading desks dealt with it, and the volatility outlook for the year. We're going to hear from David Miller, Head of EMEA Trading at Invesco Perpetual, about the impact of the disruption on price formation and risk. David, welcome to Trader TV.
Thank you.
We've seen a lot about volatility in the equity markets over the past month and a half. Could you first of all tell us about where specifically that volatility has been concentrated?
Well, predominantly in my markets, it's been sort of led by the big moves in the States. Mm-hmm. Certainly this year anyway, we had some other fairly major market moves over the last couple of years, but certainly this year, coming into a market that's dropped over 1,000 points, has caused the European markets to effectively fall out of bed, which has actually presented us with some interesting opportunities. Our investors are always looking for good pricing points to get involved, and by the means that we have at our disposal, we've managed to actually take advantage of some of the big moves as stocks have opened in relation to what happened overnight on Wall Street.
Okay. And so how does your team actually manage the trading process when you are seeing big price movements?
We spend a lot of time discussing tactics with the fund managers. We never pick up an order and not know what the fund manager is trying to achieve.
Yes.
Generally, it's price related.
Yes.
If we can work out some sort of price limit or some pricing parameters that the stock is more attractive than not, then we'll utilise that information.
Okay.
But it's important to know what the fund manager wants to achieve to work together to get the right outcome.
And is that primarily due to physical proximity? Is it due to flows of data and information? How does that manifest?
It's predominantly it's close proximity. Although having said that, we do work for fund managers that are based all around the globe who trade into this market, and we will discuss with them the various stock moves and their ideas. It is sometimes face-to-face. We do sit adjacent to some of the fund managers we deal for, but we have communication lines open with all of them. We can always get in touch with them and they can get in touch with us. If an opportunity arises intraday, we can be on their backs immediately with an opportunity should it arise. In
terms of transaction cost analysis, often that's based around historical data. So when there's a sudden period of volatility after a relatively benign market previously, or passive market, does that impact TCA?
Well, some of the benchmarks will be impacted.
Sure.
It depends which ones we choose to use. There are a number of benchmarks that we'll measure ourselves by or we'll be measured by. Some of the more important ones are, the decision to buy or sell a stock is based on a price point from the fund manager. The strategic view is taken. Then we will come in with a tactical approach to try and achieve a trading price as close to that initial inception idea price as possible.
Yeah.
Those sorts of measures, the implementation shortfall type measures, obviously will be as close to the idea as possible.
Yes.
Some of the historic measures, the T+1, T+2 measures, obviously do fall away when you have irregular moves and in highly volatile, high volume days. Measures are based on normal markets.
Yes.
And in some respects, what we've been seeing have been far from normal markets.
Yes. Yeah, quite.
But the important thing is to get the trade done as efficiently as possible and as close to that initial price point as possible.
Okay. And does it affect the extent that you use low touch and high touch, so electronic versus voice trading? Yes,
very much so.
Okay.
We've always been a desk that we have multiple electronic suites available to us. We're big electronic users, but we've also maintained very strong relationships with the voice broking community, the high touch desks, and in highly volatile markets, some of the algorithms that we may use have not been quite as efficient as picking up the phone and speaking to a specialist trader.
Sure.
Who will be our additional ears and eyes to the marketplace. We found that in some respects, some cases, the price is just moving too quickly for the algorithms to be working perfectly.
Sure.
And I think that goes to what I was saying just before. These things are built around normal, relatively sane, benign markets, and when we come in and the market is moving 5 or 6% or more in a day,
yes,
it takes a trader's experience, a traditional trader's experience, to sometimes outwit some of the algos, because we're in the same marketplace as many others.
Yes.
And we need to have the edge over the other player, effectively. I mean, it's a competitive game.
Now, we've seen the volatility index futures trading volume went up, so there were sort of some indications that there might be greater volatility from that. Are there data sources or perhaps tools that one can use to estimate when volatility might occur, or then manage the volatility that you wouldn't use in non-volatile markets?
Well, I mean, we've seen the VIX go from below 10 to above 50
yes.
in a relatively short space of time, and then back down again.
Yes.
And volumes have undoubtedly gone up against that. But
yes.
it's difficult to predict it. I mean, they wouldn't move as aggressively as they moved if we knew it was coming. So
well, that's quite
I think the volatility is there because people are least expecting that sort of move to happen.
Yes.
So it's difficult to predict. Although if we do expect some high volatile trading, highly volatile trading, we will try and get some limits from the fund managers by using price limits, both selling and buying limits. We can position ourselves to be more and more efficient, I think it's fair to say. I mean, before the Brexit vote, for example, we spoke to a number of our fund managers around the globe who were dealing into Europe, and they entered orders on the night before with low limits, sometimes down 10 or 15% from the closing prices.
Yep.
Not in the expectation that things might have changed, but as it happens, things did change, and prices did open in some cases 15-20% below where they were yesterday.
Yes.
And we managed to deal very efficiently, and of course things then changed and bounced back, and we had some of our better days.
So David, lessons from this period of volatility. Is there anything we can learn for the rest of the year?
I think the fact that we maintain a very close dialogue with our fund managers, and we sit adjacent to them in many cases as well, and understand their investment philosophies, their strategic thoughts around certain orders, will put us in a strong position to take advantage of any irregular or irrational moves in the market. Yes. That's one thing that's fairly pertinent. It's fairly clear that certain of our low-touch algorithmic trading tools, electronic trading tools, are designed more for benign markets than highly aggressive markets, and that's where we tend to move more towards a voice-broked, high-touch, for want of a better word, approach, where we are entrusting the orders to a bank or a broker.
Sure.
We tend to get better results in that respect.
Yes.
Other than that, if we could predict when markets were going to become more volatile, they wouldn't be as volatile as they are.
Right.
So it's very difficult to know, but we know we've got a strong team with a lot of experience, and we've been through these before. I'm sure we'll have instances again throughout the year and going forward where we will be able to take advantage of some aggressive moves. That's great. David, thank you very much for your time. Thank you. I'd like to thank David Miller, Head of EMEA Trading at Invesco Perpetual, and of course you for watching. To catch our reports on fixed income primary markets this month, or to subscribe, go to tradertv.net.